Preparing for a finance manager interview at Sempra Interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Walk me through your background and explain why you want to join Sempra. My background combines financial planning, management reporting, and controllership, with increasing responsibility for cross-functional decisions. I am interested in Sempra because its businesses combine essential infrastructure, long-term capital investment, and complex regulatory considerations. That environment requires more than producing accurate numbers. It requires explaining drivers, challenging assumptions, and supporting reliable execution. I would bring strong analytical discipline, practical communication, and a control-minded approach while continuing to learn the economics of utilities, infrastructure, and energy markets. While answering, connect your accounting, forecasting, business partnering, and leadership experience to Sempra's regulated utilities, infrastructure investments, energy transition priorities, and need for disciplined financial decision-making. Question 2. What do you understand about Sempra's business model? I understand Sempra as an energy infrastructure company with regulated utility operations and infrastructure businesses spanning areas such as natural gas, electricity, LNG, and energy transition development. Regulated earnings are influenced by approved investments, allowed returns, operating costs, and rate proceedings, while infrastructure results depend more on contracts, volumes, project execution, and market conditions. A finance manager must therefore distinguish recurring regulated performance from project and commodity exposure, then present both clearly to leadership and investors. Make sure to cover Sempra's regulated utility earnings, infrastructure activities, capital intensity, regulatory frameworks, project execution, customer reliability, and how these characteristics influence forecasting, risk management, and financial reporting. Question 3. How would you build an annual budget for a regulated utility? I would begin with operational drivers, customer counts, demand, weather, labor, maintenance, fuel, capital projects, depreciation, and financing costs. Next, I would reconcile the plan with approved rate cases, expected recovery mechanisms, and the timing of rate base additions. I would build base, upside, and downside scenarios, document assumptions, obtain operations and regulatory input, and establish monthly variance thresholds. The budget should remain a management tool, not a static spreadsheet, so I would refresh outlooks as facts change. In your answer, discuss operational drivers, rate base, approved capital plans, regulatory recovery, labor and maintenance costs, depreciation, financing assumptions, scenario analysis, stakeholder review, and monthly variance monitoring. Question 4. How do regulated utility earnings differ from non-regulated infrastructure earnings? Regulated utility earnings generally reflect a framework intended to recover prudent costs and provide an authorized return on invested rate base, subject to regulatory approval and performance requirements. Non-regulated infrastructure earnings are usually driven by contracts, project availability, volumes, commercial terms, and market conditions. That distinction affects forecasting, risk assessment, and valuation. I would avoid applying one template to both businesses, instead using rate base and regulatory assumptions for utilities and contract, milestone, and market assumptions for infrastructure assets. Be sure to mention cost of service regulation, authorized returns, rate base, deferred balances, contractual revenues, market exposure, project milestones, and why segment-specific performance metrics are essential. Question 5. Describe your approach to forecasting cash flow for a capital-intensive energy business. I would separate operating cash flow, investing cash flow, and financing cash flow, then build each from operational assumptions rather than simply applying a percentage to earnings. Key inputs would include collections, fuel and supplier payments, working capital, capital project timing, tax payments, debt service, dividends, and regulatory recovery. I would maintain a 12 to 18-month liquidity view, test delayed projects and adverse commodity scenarios, and reconcile the forecast to actual bank activity and treasury expectations. Focus on EBITDA conversion, working capital, capital expenditures, regulatory timing, project milestones, taxes, debt service, restricted cash, liquidity buffers, and sensitivity analysis around major execution and market risks. Question 6. How would you analyze a significant capital project before recommending approval? I would first confirm the project's strategic purpose and whether it supports reliability, growth, customer needs, or energy transition objectives. Then I would test scope, schedule, cost estimates, procurement assumptions, financing, regulatory recovery, contractual protections, NPV, and IRR. I would run sensitivities for delays, cost overruns, lower volumes, and changed market prices. My recommendation would clearly separate quantified returns from strategic benefits, identify approval conditions, and establish milestones for monitoring benefits, spending, and risk after authorization. Discuss strategic fit, scope, cost estimate, schedule, NPV, IRR, funding, regulatory recovery, contractual protections, sensitivity analysis, execution risk, and post-approval governance. Question 7. What financial metrics would you use to evaluate utility performance? I would use a balanced set of financial and operating measures. Financial metrics include revenue, operating expenses, EBITDA, earnings, operating cash flow, capital spending, rate-based growth, leverage, liquidity, and return on equity against the authorized level. I would pair those with reliability, safety, customer, and project delivery indicators because short-term savings can damage long-term performance. Finally, I would explain variances against budget, prior year, and regulatory commitments rather than relying on isolated ratios. Mention revenue and earnings drivers, O&M efficiency, capital deployment, rate-based growth, cash flow, allowed return performance, reliability measures, leverage, liquidity, and comparisons against budget and regulatory commitments. Question 8. Tell me about a time you identified a material budget variance. In one role, maintenance expense was running approximately 12% above budget by mid-year. I decomposed the variance into labor, emergency work, contractor rates, and timing, then found that several planned outages had shifted into the current period. I partnered with operations to revise the schedule, separated timing from true run rate pressure, and updated the forecast with a management action plan. The result was a more credible outlook and a recurring monthly review of outage assumptions. Use a concise star structure, quantify the variance, explain root cause analysis, describe stakeholder collaboration and corrective action, and show how you improved controls or forecasting afterward. Question 9. How would you explain a complex financial variance to a non-finance executive? I would start with the headline, what changed, by how much, and whether it affects earnings, cash, or timing. Then I would explain the operational cause in plain language, distinguishing a temporary timing item from a permanent run rate change. For example, I might say that spending is $4 million unfavorable because equipment delivery moved forward, but the full-year forecast is unchanged. I would finish with the recommended action, decision required, and supporting detail available if needed. Focus on the executive headline, financial magnitude, operational cause, timing versus permanent impact, recommended action, decision needed, and concise visuals supported by reconciled detail. Question 10. What is your approach to monthly close and management reporting? I manage close through a documented calendar with clear owners, dependencies, review points, and escalation rules. I prioritize high-risk areas such as accruals, cutoff, capital project costs, intercompany balances, regulatory accounts, and unusual transactions. After the ledger closes, I reconcile results to operational drivers and investigate material variances before issuing management reports. I also track recurring late items, automate where practical, and improve the process only after confirming that control evidence and reporting quality remain intact. Cover close calendars, ownership, reconciliations, accruals, cutoff, intercompany activity, variance analysis, review controls, reporting deadlines, automation, and continuous improvement without sacrificing accuracy. Question 11. How would you assess whether an accrual is complete and reasonable? I would combine quantitative evidence with operational confirmation. I would review open purchase orders, receiving reports, contracts, invoices received after close, service completion records, historical spending patterns, and subsequent payments. For large or unusual items, I would contact the business owner and document the basis for the estimate, including timing and contractual terms. I would also evaluate cutoff and automatic reversals, then compare actual invoices to prior accruals to identify systematic bias or control weaknesses. Mention purchase orders, invoices received after close, service confirmations, contract terms, historical run rates, operational input, cutoff, subsequent disbursements, reversals, and documentation of judgment. Question 12. What internal controls are most important in a finance manager role? I focus on controls that prevent or detect material misstatement and protect cash and assets. Important examples include segregation of duties, approval limits, journal entry review, account reconciliations, procurement authorization, capital project governance, access management, estimate review, and evidence retention. I test whether controls operate consistently, not merely whether policies exist. When an exception occurs, I determine root cause, assess its impact, implement remediation, and follow up to confirm the fix is sustainable. Discuss segregation of duties, journal entry approval, account reconciliations, access management, procurement controls, capital authorization, estimate review, evidence retention, monitoring, and remediation of deficiencies. Question 13. How do you distinguish a capital expenditure from an operating expense? I distinguish the items by asking whether the spending creates or enhances a long-lived asset and provides probable future economic benefit beyond the current period. Routine repairs, maintenance, and administrative costs generally belong in operating expense, while qualifying construction, replacement, or betterment costs may be capitalized under policy and accounting standards. I would review the invoice, project scope, asset component, useful life, and approval documentation, then ensure depreciation begins when the asset is placed in service. Be sure to cover future economic benefit, useful life, unit of account judgment, repairs versus betterments, internal policy, project costs, startup expenses, impairment implications, and documentation. Question 14. How would you analyze a utility rate case from a finance perspective? I would start with the revenue requirement, prudent operating costs, depreciation, taxes, and a return on rate base, supported by the approved cost of capital. I would analyze the test year, adjustments, capital additions, customer growth, regulatory lag, and recovery mechanisms. I would also model the earnings and cash impact under different outcomes, identify contested assumptions, and coordinate with regulatory, operations, tax, and treasury teams. The objective is a defensible filing and a clear understanding of downside and timing risk. Discuss test year, revenue requirement, rate base, operating expenses, depreciation, taxes, cost of capital, authorized return, regulatory lag, recovery mechanisms, and earnings sensitivity. Question 15. What is regulatory accounting, and why does it matter to Sempra? Regulatory accounting allows qualifying costs or benefits to be recognized in the periods when related customer rates are collected or refunded, provided recovery or repayment is probable under an applicable regulatory framework. This can create regulatory assets or liabilities and materially affect earnings timing, cash flow presentation, and disclosures. At Sempra, I would monitor commission orders, approved amortization, balances, and recovery status closely, while reassessing probability and documenting judgments whenever regulation or operating conditions change. Explain matching qualifying costs and revenues across periods, probable recovery or refund, regulatory assets and liabilities, commission orders, amortization, disclosures, and the importance of evidence and reassessment. Question 16. How would you evaluate a forecast when commodity prices or demand are volatile? I would avoid relying on a single point estimate. I would model price, volume, weather, transportation, and customer demand drivers separately, then incorporate hedging and any regulatory or contractual pass-through mechanisms. I would present base, downside, and upside cases with clear probability or scenario assumptions, including earnings, cash, and liquidity effects. I would also distinguish market-driven changes from controllable operating decisions, because management needs different actions for each category. Mention driver-based modeling, price and volume sensitivities, hedging, pass-through mechanisms, scenario ranges, probability weighting, liquidity effects, and separation of controllable from uncontrollable factors. Question 17. How would you assess liquidity and financing risk for an energy infrastructure company? I would build a rolling liquidity forecast covering cash, operating inflows, capital commitments, debt maturities, interest, dividends, collateral, and restricted cash. I would compare projected needs with revolver capacity, commercial paper access, committed financing, covenant headroom, and market conditions. Stress cases would include delayed collections, project overruns, higher rates, weaker commodity prices, and reduced capital market access. I would communicate early warning indicators and contingency actions rather than waiting until a funding gap becomes immediate. Focus on cash balances, revolver availability, debt maturities, covenant headroom, committed capital, commercial paper, interest rates, stress testing, counterparty exposure, and contingency actions. Question 18. What are the key accounting considerations for a long-term infrastructure contract? I would begin by understanding the contract's rights, obligations, pricing, termination clauses, and promised goods or services. Then I would identify performance obligations, assess whether revenue is recognized over time or at a point in time, and evaluate variable consideration, volume commitments, modifications, and collectibility. I would involve legal and commercial teams because contract language drives accounting conclusions. I would document the judgment, establish monitoring controls, and revisit the analysis when scope, pricing, or operations change. Discuss contract identification, performance obligations, pricing, variable consideration, volume commitments, termination rights, modifications, revenue timing, collectibility, and coordination with legal and commercial teams. Question 19. How would you manage a finance team through a tight reporting deadline? I would identify the critical path, assign explicit owners, and distinguish must-have close activities from work that can follow. I would begin with high-risk accounts and dependencies, hold brief status checks, and escalate blockers early rather than compressing review time at the end. I would protect segregation of duties and approval quality even under pressure. After reporting, I would conduct a short retrospective, capture recurring bottlenecks, and adjust the calendar, staffing, or automation for the next cycle. Cover prioritization, clear ownership, critical path planning, early risk identification, daily communication, review discipline, escalation, workload balancing, and post-close lessons learned. Question 20. Describe a time you challenged a senior stakeholder's financial assumption. A business leader once assumed a project would be operational by quarter end, although procurement data showed a material equipment delay. I did not simply reject the assumption. I prepared a schedule-based analysis with base and downside cases, quantified the revenue and cash effects, and proposed milestone triggers. The leader accepted a revised forecast and contingency plan. That experience reinforced that finance adds value by challenging assumptions constructively, using evidence, and preserving the relationship. Demonstrate respectful challenge, evidence-based analysis, alternative scenarios, awareness of business objectives, clear recommendation, and an outcome that improved decision quality or forecast credibility. Question 21. How would you improve a finance process that relies heavily on spreadsheets? I would first map the process and quantify the risks, rework, manual touches, and reporting delays. Then I would standardize definitions and inputs, assign data ownership, introduce validation checks, and reduce duplicate entry through system integration or controlled automation. I would preserve an audit trail, access controls, and documented review evidence. I would pilot the change with users, measure time saved and error reduction, and avoid automating a poorly designed process before fixing its underlying logic. Mention process mapping, risk assessment, standardized inputs, data ownership, system integration, validation checks, version control, automation, audit trail, user adoption, and measured benefits. Question 22. How do you ensure accurate financial reporting across multiple entities or segments? I would establish common accounting policies, a controlled chart of accounts, standardized reporting packages, and a calendar with clear submission and review deadlines. I would pay particular attention to intercompany balances, eliminations, equity activity, shared costs, and differing local processes. Entity-level reconciliations and analytical reviews should precede consolidation. I would maintain a central issue log, involve local subject matter experts, and use recurring error trends to strengthen instructions, training, and preventive controls. Focus on common accounting policies, chart of accounts governance, consolidation rules, intercompany eliminations, reconciliations, reporting calendars, local expertise, review controls, and issue escalation. Question 23. What role should finance play in Sempra's energy transition investments? Finance should translate energy transition ambitions into disciplined investment decisions. I would evaluate lifecycle economics, reliability benefits, regulatory treatment, policy incentives, technology maturity, construction risk, operating costs, financing, and market scenarios. Some benefits may be strategic or environmental rather than immediately reflected in earnings, so I would make those assumptions explicit instead of overstating returns. Finance should also monitor milestones and realized benefits, ensuring capital allocation supports both long-term resilience and acceptable risk-adjusted returns. Discuss strategic alignment, regulatory and policy assumptions, technology risk, carbon and reliability benefits, lifecycle economics, funding, scenario analysis, stakeholder expectations, and disciplined capital allocation. Question 24. How would you respond if you discovered a potential financial reporting error after close? I would first preserve the evidence, understand the transaction, quantify the error, and determine whether it affects earnings, cash, disclosures, controls, or prior periods. I would promptly inform the controller and relevant stakeholders rather than attempting an unsupported adjustment independently. Following policy, I would assess materiality and correction options with audit involvement where appropriate. I would document the conclusion, identify the root cause, and implement a control improvement so the issue does not recur. Mention fact gathering, materiality, control assessment, escalation, correction under policy, documentation, auditor coordination, root cause analysis, disclosure considerations, and prevention of recurrence. Question 25. What would success look like in your first 90 days as Sempra's finance manager? In the first 30 days, I would learn the business, regulatory context, systems, reporting calendar, key forecasts, and stakeholder expectations. By 60 days, I would assess close, planning, controls, team capacity, and recurring pain points, while delivering a few practical improvements. By 90 days, I would present a prioritized roadmap with measurable outcomes, ownership, and timing. Success would mean earning trust, producing reliable analysis, understanding the drivers behind results, and helping leaders make better decisions. Be sure to mention listening, business and regulatory learning, relationship building, process assessment, quick wins, control awareness, forecast understanding, team development, and a prioritized improvement roadmap. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.